Act 1956 has been modified and brought into 2013 Act, the OPC has actually come in our country. The OPC was very popular in the up countries where it was popularly known as a single person company. When I was working overseas, I have actually seen even the haircutting salons, they all incorporated one-person company in overseas. Because whenever I went to have a haircut, I just saw so-and-so salon, so-and-so SPC. So I just inquired, then I came to know this is actually a SPC company. So it has been very popular in the SPC earlier, which actually has come in the 2013 Act, which is the region origin in our country. The OPC, as the name itself suggests, it is actually a one-person company. So that means what today we are having a sole proprietor. The sole proprietor can actually incorporate a company, which is actually a one-person company. And what is the advantage of a one-person company is, since the incorporation of the company is done, the company is a separate legal entity. When it is a separate legal entity, then what happens is the person is different from the company. So there is a limited liability as a capacity of the shareholder for him as a company. Because in sole proprietorship, what happens is there is an unlimited liability there, which is safeguarded here. And second thing is here, what happens is there is a continuous existence, because once you incorporate the company, it is having a perpetual succession under the law. Because this has got a nomination facility. So even if he is not there, the company will actually continue with the nominee. And of course, once you incorporate the company, it is actually finding a place in the MCA. It is available in the public domain. There is a greater credibility is actually available. And of course, the banking and financial organization will also recognize as a company when it comes to the financial assistance, etc., which is actually coming over. So there are various advantages are there in incorporating the one-person company. And today, Nikhil will actually take us through the various concepts of the one-person company and the incorporation procedure and what are the benefits of the one-person company. And also there are a lot of exemptions available because he is being a one-person company. So, you know, naturally the quorum requirement, then again issuing a notice for the general meeting, etc. And then again circulation of the minutes, all those things which are actually exempted here. And again, from the compliance part of it, it is also to the greater extent, it is a minimal compliances which are actually there in terms of the one-person company. It has got a lot of advantages, but a one-person company cannot be for any length of business. There is actually a limitation there. The moment the 2 crores business turnover is achieved for a consecutive period of 3 years, then naturally this company is no longer going to be a one-person company. It is mandatorily required to be converted as a private company or a public company. That procedure is also there. And again, one-person company, if they want, they can actually get a equity capital. They can convert it to private company, public company. Similarly, a private company wants to convert into a one-person company, vice versa. That is also possible. So I think the first session, Nikhil will take us through the one-person company. Then we'll come to the risk management. Over to Nikhil, please.
Nikhil, you may start the presentation. Your phone is, you are on mute.
Can you hear me now?
Yes.
Okay. Can you see the screen?
Directly it has come to the 5th slide.
Just, yeah, make it full screen.
You have to make it full. You have to run a presentation mode.
Yeah.
Slideshow. Click on the slideshow.
No. You just need to click the play button at the extreme right.
1 second.
Bottom, right bottom. Extreme right bottom. Play button. Yes.
Okay. Should I start, ma'am?
Yes.
So I'll just adjust my camera. Good morning, everyone. My name is Nikhil Palya from Ashwini Ma'am's team, working under Suchita Ma'am, Yogita Ma'am. So I'll be giving presentation on 1% company.
वाइब्रेट हो रहा है यार
कोई issue आ रहा है? नीतू मैम कुछ? Hello. Echo आ रहा है? Neetu ma'am, can you hear me now?
Yes, I can.
Oh, it's not echoing, I think so. Yeah. Yeah. So I'll just start it. This is my presentation.
It will be a bit louder.
Okay. I'll just increase the voice. Yeah. So I have made a summary of this. I'll be explaining all these points: the definitions, benefit, what is the incorporation process, annual filing, meetings, comparison with other entities, conversion, amendments, and taxation norms. Okay, so the definition as per section 2, section 62, subsection 62 of the Companies Act, one person company is like covering, not covering to the definition. Simply we can understand what is a 1% company. Means the company operated by one person. So the definition also stated that like that only the company which has only one person as a member. There's no limit for directors and all, but there's a limit for member, that one person is only a member over there. Yeah. So the company means the company incorporated under Companies Act, and members. Members means who has subscribed the memorandum of the company, who are other than who have given a written consent and written to become a member in register and whose name has been registered in the members. Okay. Okay. So yeah, so I was a member. That's a member is a member who is a who has subscribed to memorandum of the company, who have given the written consent and whose name has been registered in the members. As per demat consent is concerned, so who is beneficiary owner and own the records of the depository, like CDSL or NASL is the depository of India. So who have name registered as a beneficiary owner, they also be considered as a member. Now this is the benefits. This is the benefits of the one person company. The first is lesser compliance burden. Lesser compliance burden can be explained like that as compared to the private company or public company. They are very much lesser burden on a compliance, and very much exemptions are given to one person company. So I'll be covering exemption in further slides. So yeah. The second is organized sector as compared to the proprietorship company. The organized sector in the sense is as benefits and compliance burden are lesser, and we can get a facility of banking facility in a lesser norms as compared to the sole proprietor. Sole proprietorship doesn't get that much benefit as compared to the one person company. Then benefits are there. The banking facility, the limited liabilities are there. So as compared to the sole proprietor, this is the benefit for one person company. The minimum requirement is minimum one shareholder, minimum one director. There can be more than one director. Yeah, the director and the shareholder can be the same person. This is the catch point over here. The director and the shareholder can be the same person. The minimum one nominee. The nominee concept I have been explained in the further slides, so I'll be explaining over there. No need of minimum share capital. This is one of the important point over here. As compared to the private company also not required, as the other also provision has been omitted. But in considered to one person company, this also there is also this provision. Yeah. So limited liability. Limited liability is the liability of the person is limited to the extent what he have invested or what the extent the paid up share capital is. So there's a limit over there. Then this separate property, obviously separate property, whatever the property of the one person company is a separate property and doesn't require any burden or any liability on it. And it is separately identified and functions separately. transferability of shares. There's no question of transferability because there's a one member. But if the shares have been transferred, the purpose of the 1% company will be defeat. The main purpose of 1% company is to run the business and operate by 1%. So the transferability question is not if there's a transfer, the purpose of the 1% company will be defeated. The taxable flexibility in the sense we can consider this we can say like that, if there's a director and we give the remuneration rent, or the director can be a leaser, can get a rent, and can be a creditor. Director can also be a creditor of the company, means if in which he is a director in the company, he can also give the advances and something like that. So the whatever the interest, rents and remuneration he gets in the company of the directors, that can be get deducted or deductible, and income tax burden on the 1% company get reduced. So that's the important point over here as compared to taxability. And I've covered the rates and all in the further slides. I'll be explaining over there. Complete control of the company with a single owner. There's a complete control with a single owner. Means he has a quick decision. We don't have any burden to get a compliance or get a approvals and all. He can get a quick decision on it. He can get a command on it and make a execution very faster. He don't have to take the very much approvals of all the concern, all the board panels and all, because there's no board only. I'll be covering on the next point. Legal status and social recognition. This is the most important point I've covered over here. Social recognition as compared to the other, as compared to the sole proprietorship. Sole proprietorship does not get social recognition, does not get corporate status as compared to 1% company. 1% company gets a corporate status, most popular business structure, and many exemptions are given. Large corporate prefer to deal. Large corporate who are the large corporate who prefer to deal with 1% company because there is a socially recognized sector. Yeah. Next slide I'll be. Yeah, exemptions. These all are the exemptions, key exemptions, we can say like that. The 1% company gets the one director. There's only one director required to run the business. This not a limit of bar. This is the exemption that one director can run. As compared to a private company requires two directors to run. So there's a one director can also run the business in his mindset, or his and he gets the relaxation on it. He can take the decisions very quickly and fast. And this exemption is applicable only on 1% company. Holding of AGM. Holding of AGM was one of the important part for the private companies. But as compared to the AGM to the 1% company, business translation to doesn't require the AGM because there's only a one member, one person, and one person cannot hold the AGM. Business translated to general meeting. Only general meeting will held over there. Holding a board meeting. Each board meeting may be held if there is more than one director. If there is a single director, the board meeting provisions are not applicable. Board meeting will be held in within 6 months of the calendar year, once in a 6 months, and 90 days gap between two board meetings. Signing of financial statements. Usually the director and the CS, the company secretary, signs the financial statements of the company, and the OPC here the OPC consider if there's a CS in OPC, so CS will sign, and if no CS, then the director alone can have the authority to sign. Signing of financial cash flow statement. Cash flow statement is not applicable to the company, not required to. Then the cash flow audit report and auditors. Not audit report as per company's auditor report order 2016, the provision is not applicable to 1% company. These all are the exemptions which the 1% company gets. Incorporation. There are two specific types of incorporation. Without filing a REN, we have to file a SPICE form. Without filing a REN, or with REN. REN is also known as reserve unique name. Yeah, sorry, reserve unique name. So So we can do like we have two options: without filing a rent and with filing a rent. If we go without filing a rent, there are 5 specific services available over there: name reservation, allotment of den, incorporation of the new company, allotment of PAN, and allotment of TAN. Yeah. So through SPICE form and INC 32, we can do that, and with EMO and EAOA, INC 33 and INC 34. If there's a specific requirement, there's a specific requirement, and if the electronic MOA and electronic AOA is not applicable, so we can file an attachment of PDF file towards it and file and incorporate the OPC. And second step is with run. Name reservation run service will be used for name availability. First, we have to apply for a run. We have to reserve the name, and then we have to file accordingly. And the company shall, after considering all the requirement of the run, then we have to do INC 22 within 30 days. Once the SPICE form is registered, that only the run. Yeah. The process of 1% company incorporation. This is a process. We can check. We can say this is a checklist. We have to follow it. This is like the check eligibility. What are the eligibilities? Check documentations. What are the documentations? Apply for DSC and name of the director, who will be the director of the companies. Application for name reservation, as we see in the previous slide, there are run considerations over here. File SPICE plus form for incorporation, companies incorporation, apply PAN and TAN for a new company, and ROC issue a certificate of incorporation. After all the steps, the ROC will issue the certificate of incorporation, and we have to mandatorily open a bank account and start the operations. This is the requirement. Yeah, this is the basic details about 1% company. Minimum paid up share capital is 1 lakh. It is not mandatory, but it is considered that it should be 1 lakh. It will only have a 1% as a member. MOA will have considered MOA of the company will be considered a nominee. I'll be covering the nominee part in a further slides. Name of the nominee will be upholding the position of upholding the OPC after the death of the member or something like that. I'll be covering in the next part. The member of OPC will have the right to change the nominee. Yeah, they can change the nominee due to intimation to the registrar. OPC can be formed as a company limited by shares or limited by guarantee also, or unlimited company also. Yeah. So 1% company, this is the basic details of it. The 1% company can also form by 1%. And also only by formed by resident and citizenship. The 1% can be formed by only resident and citizenship have an amendment. I'll be covering in the amendment slides. There's an amendment over here that I'll be covering in the further slides. Dean of directors are required. DSC is also important part. Yeah. Meetings. Meeting is an important part where there's a director, more than one director. Means at least there should be a 2 director. Then only this meeting parts that's applicable on 1% company. If there's 1 director, no required to get a meeting. This part to be get applicable. Yeah. So I have said that like that only the at least in a calendar year within 6 months there should be 1 meeting and should have a gap of 90 days. The calendar year is January to December. Yeah. So I will cover this all part. When 90 days gap is applicable, whenever there's a 2 or more directors, this gaps are applicable within 90 days. And there's no bar to start to have only 2 meetings. There can be a more than 2 meetings, but at least there should be two meetings with a gap of 90 days in each of the 6 months of the calendar year. Other compliances meeting is statutory registers are important, such as director registers, director shareholders registers, related party registers, as same as a private company. Private company also require these types of registers, and this OPC also required this type of register. A director reports is also required. It should be bring to the board to get for signing and all before AGMs. Yeah, this is an annual filing required for OPC. Annual filing, disclosures of disqualified in this thing. DR8 is required. MBP1 is required, same as private company. DR3 is required to be done of directors. MSME one, if we have borrowed money from the vendors who have registered in MSME, and there are two types. We have to make the filing in two types. 2 times in a year. Sorry, 2 times in a year. In April to September, one filing is to be done, and October to March, one filing is to be done. DPD3 also required if there is any deposit or loan and something like borrowing has been taken or has been outstanding. ADD1, MGT7 is required. AOC4 is required. And there's an amendment in MGT7 I'll be covering in the next further slides. This is the difference between private OPC and sole proprietorship company. 1-person company and sole proprietorship. I've covered in a summary way what are the benefits and what it can be, and separate legal status. Sole proprietor does not get in separate legal status as compared to the 1-person company. 1-person company has a separate legal status, and the person behind the 1-person company doesn't get any liability on it. All the liability occurs on 1-person company as compared to the sole proprietorship company. The sole proprietor company is who is controlling the members, who are controlling members, does not get any protection, does not get any, all the liability come on them only. So this is separate legal status, and it can sue and can be sued. Liability of owners. The liability is limited up to the paid up share capital. They are liability in sole proprietorship company. They are not liabilities limited to the paid up share capital, but rather their personal asset also come in the picture. Number of directors. Minimum 1 director is minimum 1 director is required, and 15 maximum 15 directors required. And there's no concept of director in a proprietorship firm. The sole owner is the only person involved. Succession in the sense there's a concept in a 1-person company is a nominee, because the member is okay. In case of the death of the member, the nominee upholds the 1-person company. Yeah, so I'll be covering in next further slides that's part. And there's no perpetual succession. There's no in sole proprietorship company. There's no perpetual. This is the reason why the large corporate doesn't deal with the sole proprietorship companies, because there's no succession or there's no perpetual succession of sole proprietorship company. Yeah. So yeah, registration OPC. Registration OPC is done with ROC, and it's specific towards some specific kinds only. I mean, they can't register in every sector as compared to sole proprietorship company. They can register in MSME, Shops and Establishment Act, GST, professional tax, and there's a various kinds of registration. This is a benefit to sole proprietorship company because there's no specific act for it. There's a specific act for OPC. Taxability. The OPC taxable as a company. As a company only, and there's no separate existence, and the taxability for 1-person sole proprietorship company is like an individual taxable. Like individual get taxed, the sole proprietorship company also get sole proprietor also get that type of taxability. Compliance as is same as Companies Act, as same as Companies Act, and compliance for this is the mandatory compliance is for sole proprietorship company is tax filing, income tax filing, because they have to show the income, what they have earned and what they have. And for 1-person company, all the regular compliance what a private company has, and there is something many more exemptions as compared to private company. Yeah. So public data, the data of the OPC are available on MCA. One of the important benefit for one is like we can get the data of 1-person company on an MCA portal. The constitution of data, the constitutional documents such as MOA are also available. This is one of the disadvantage for sole proprietorship company. We don't get any data from any data of the firm or on any site and all, because MCA doesn't consider sole proprietor. Unique name. So we can apply for a unique name and it is get registered. And once we get the name for sole proprietorship 1-person company, so secondly anybody cannot take the same name and cannot use the name. But as compared to the sole proprietor company, the sole proprietorship can take any of the name and they get exist a uh, confusion of the names. The same name occurs in many of the times. This is the disadvantage of the sole proprietorship. Constitutional document, there's a constitutional document, MOA, AOA, Memorandum of Association, Article of Association. There's no such document. There's only they can have an agreement or something like that for sole proprietorship. But as compared to the OPC has a Memorandum of Article, Association Article, the important documents. Lock-in period, the conversion. This is a more important part. To convert OPC into private company or public company within 2 months, 2 years, there should be a lock-in. Means once I have registered as a OPC, I can't convert for 2 years voluntarily. But there's a amendment over here. I will cover in the next further amendment slides. There's a budget amendment over here. Yeah. No minimum lock-in period to convert a proprietor firm to any other entity. The proprietor firm can be converted to any other entity at any time. There's no any lock-in period. The difference between private company and one-person company. So as a definition part, section 2, subsection 62 of the one-person company means the company which has only one person as a member. And section 2, subsection 68 of the Act says that what are the private company? The company having a minimum paid up share capital, the 1 lakh limit has been omitted over here, and which by it articles restrict the right to transfer shares. Except in case of one-person company, the limit of the member is 200. The minimum limit is 2 and maximum is 200. There's only limit, and prohibits any invitation to public subscribe for any securities of the company. There's a prohibition on it. The number of person here, the shareholding in one-person company, the shareholding is for one member only. So there's 100% holding for sole owner, and in a private company the minimum is 2 and maximum is 200. So there's a number of persons over here. Nominee, the concept of nominee over here is, I'll just insert. Yeah. Basically, the nominee concept is very much important for one-person company, because large corporate deals because of this concept only, because there's no end to the one-person company as the nominee concept is existed. The first concept is to retain the perpetual succession. The nominee concept is basically existed because to retain the perpetual succession of the one-person company. Because there can be an incapacity or death of the person who is operating the one-person company, then the nominee comes to the picture and take over and retains the perpetual succession of the company. The nominee should be an Indian resident. Written consent during OPC registration is required. Means who will be the nominee, he has to give the written consent during the registration of the one-person company, and can be changed at a later stage. The nominee which has been registered or which has given the one-person company, the shareholders can further change the nominee as per the consent. So this is the concern of the one-person company nominee. And the private company doesn't have any this type of provisions. There's only a single provision of minimum 2 and maximum 200 members. Number of director. In one-person company, minimum 1 director is required, and maximum 15 director. As compared to private company minimum 2 directors, maximum 15 directors. They can alter the articles for further. Ownership and control. The ownership is involved in the hand of sole member in case of OPC. Means as I explained in the previous slide, the one person only can manage the affairs of the company. There's a quick decision making process, and these all are the benefits. And the ownership and the control is one of the most important benefit to the one-person company. Yeah. Business activities. There's no restrictions. There's no anything restrictions to the private company, but there are certain restrictions to one-person company, because they cannot do the business activity of professional banking, NBFC, non-banking financial activities. They can't do activities of banking, financials, and investment in securities, etc. Cannot carry out any of the business like that. As compared to private company does not have any bar, or they can induce in such activities subject to such prior approvals or regulatories. Means if they are going to invest in securities, they have to get the approval of regulatory such as SEBI, Security Exchange Board of India. Investment by foreign national. The investment is not OPC in India by foreign national as a member is not permitted, as only Indian resident can become a member of the company. And there's an amendment over here. I'll be explaining in the amendment slide. However, in case of the private company registration, NRI, foreign national, and foreign entity are allowed to hold securities, hold shares, securities subject to FDI guidelines. 100. There are two types of FDI guidelines: automatic route, approval route. So as private company is concerned, they can take the foreign holding or like that. Fundraising. The fundraising for the investor is not possible in form of equity investment. Means OPC cannot get the investment in case of equity, because there's a limit on membership. As there's no limit on directorship, but there's a limit on membership in case of OPC. So they can get the form, they can raise the fund as in equity investment. But for private company, the fundraising through issue of equity is possible in many ways, including private placement, right issue, venture capital, etc. For the internal funding has better phase than OPC, as there's more one contribution. Taxability, as said in previous slide, is same as company is taxable, and private company has different rates. As it also taxable as same, means both the taxability are the same. The concept of OPC is not recognized under income tax, so hence the company will be put in the same category as other companies for taxation purpose. And the private company has a basket rate of 30%, and all the cess and surcharge included. Audit and annual compliances. The audit is mandatory for any company registered under Indian Companies Act. It is an important point. The annual compliance part, both OPC and a private company shall obtain a statutory auditor within 30 days of the registration. The annual compliance will include filing forms, as I have covered in the previous slides, with MCA for each financial year. Additionally, both must file the income tax return for each financial year. Yeah. The other compliances such as meetings, AGMs, as a private company has a limitation. Within 120 days, they have to consider all the meetings, all the board meetings, and within before 30th September, they have to take the AGMs. This is the compliance. This is the mandatory compliance of private company. The OPC enjoys certain exemptions on it. So yeah, as compared to private company. Conversion OPC, there's an amendment over here. I'll be explaining the amendment part. So yeah, the conversion can be done if the limit exceeds, that the paid up share capital exceeds 50 lakhs rupees or turnover exceeds 2 crore rupees. The OPC shall convert itself in a private or public company. Therefore, there's a ceiling limit provided to operate under OPC. In case of private company, no restrictions or limitations are provided. They can freely operate them. Further, if the promoter wants to convert the OPC voluntarily into other companies, the minimum period of 2 years shall pass since 1% company's registration. Yeah, conclusion, there are both advantages and disadvantages accompanied to every organization. If one can balance the pros and cons in situation context by considering above discussed features, it is easy to set up the means we can say like that the OPC and private, they have the specific benefits in the concern. The one have to consider in what sector he has to function. So that's an important point over here. Yeah, this is a summary list of what we have seen in previous slides. The applicable law is Companies Act. Minimum paid up share capital is not applicable, but if the limit exceeds in OPC, they have to convert it. Minimum members, 1 member, and maximum members is only member. This is an important part over here. In private company, minimum 2 members and maximum 200 is required. Director required. Minimum 1 member, maximum 15, minimum 2, and maximum 15. Board meeting, 1 board meeting in each half of the year, and a gap of 90 days in 2 meetings. There's a in Private company maximum 120-day gaps is required for each meeting, and each one meeting should be held in 1 quarter. Statutory audit is compulsory for both the companies, private or OPC. Annual filing is financial statements, annual report are to be filed, and there's an amendment over here. I'll be explaining next for the slides. Liability limited company's name. This is an important point. The company name in case of the OPC, and it should be end with OPC private limited or OPC public or whatever the same case may be. And in a private company, it should be end with private limited. Yeah. Amendment. There's a first amendment over here is who can incorporate OPC. The current provision is OPC can only be incorporated by a natural person who is an Indian citizen and a resident in India. But as proposed by the Union Budget 2021 and 22, now OPC can also be incorporated by a non-NRI, non-resident Indian. Now the OPC can be also be incorporated by NRI. So there is a first amendment over here. The second amendment is who will be considered as a resident in India. The person who has stayed in India for a period of not less than 182 days will be considered as a resident of India. But as proposed by the Union Budget 21-22, the person who has stayed in India for a period of not less than 120 days. Now the limit has been reduced to from 182 days to 120 days. Can be considered as resident in India. Conversion of OPC into any other kind. This resident part is important for nominee because the nominee should be an Indian resident. So this is important for nominee to become a nominee in OPC. Conversion of OPC into any other kinds of company. The OPC cannot voluntarily convert itself into any other kinds of company unless it is fulfill any of the other conditions. A period of 2 years is expired from the date. This is the conditions if conversion if OPC wants to convert in other kinds. The period of 2 years is expired from a period date of the incorporation. It paid up share capital is increased beyond 50 lakhs, your turnover has increased beyond 2 crores. Now the amendment is the OPC can voluntarily.
One second. Ms. Pooja Gupta, can you please mute your phone? Ms. Pooja Gupta, to mute your phone, please.
Thank you. Okay. So I was saying about voluntary conversion. So now they can convert voluntarily itself into any other kinds of the company at any time without meeting any of the criteria, means whatever the above criteria is, as paid up share capital and average annual turnover. So now they can convert voluntarily also. So this is an important amendment over here. They don't have to consider any of the conditions. They can convert voluntarily also. Yeah. The fourth requirement is the requirement of the compulsory conversion not exceeding the specific turnover is done away. Means if there is an exemption, if they exceed beyond 50 lakhs or beyond 2 crores as compared to paid up share capital and turnover, they don't require to convert. Now the OPC can grow without any restrictions. This is the most important amendment in OPC, and this will be effective from 1st April 2021. So this is the important amendment over here. This is an important form and for annual return as MGT 7A. For beyond previous years, there was MGT 7 for all the private companies, public companies, OPC, all the same. But now this form has been introduced for 1% company and a small company. The form is applicable from this year, from last year for this year, 1920 filings, 2021 financial year, and onwards of OPC and small companies. And all other companies shall continue to file the annual return in form MGT 7 only. But as compared to 1% and small company will now file MGT 7A with ROC, with staffers. Yeah. This is the content of the form. This is the content of the form, and what form doesn't applicable. What content doesn't applicable to the this MGT 1% company, means what this all also contained in MGT 7, but now in this new form, this all contents are not applicable for 1% company. Means 7A form, means NGT 7A form doesn't contain this all says. Date of AGM is not considered. Particular of associate companies like holding and subsidiaries not considered. Details of unclassified shares, share capital not considered. Breakup of share capital not considered. Details of share and debenture transfer, shareholding pattern, members and other meeting details, details of board meeting, attendance of director. Yeah. Taxation norms. Taxation norm is 1% company is simply charged taxable as a company only, but is a taxability of 30% plus surcharge and cess, whatever the current surcharge and cess is going on, and separately on distribution of profit by IPC. If OPC distribute the profits to its sole members, the OPC will be subject to dividend distribution tax at 20.56%. So this is a taxability norms. Yeah, so this is all about OPC, and this was, I've covered everything.
There are two questions are appearing on the chat
Sure,
box,
sure.
Nikhil.
Yeah.
The first question is, if in OPC there is only one director, how can the board meeting be convened?
Exactly, sir. If there's a one director, there can be a board meeting. But if there's more than one director, then only and the board meeting provisions will be applicable.
No, that is right. But here it is at least once in a half a year, the meeting is to be there. Here, as we know, the company is actually a separate legal entity.
Hmm.
So the person is actually a shareholder, is actually a member, a director.
Hmm.
So now what happens is, because for the purpose of carrying on whatever the decision he has taken, he has to actually formulate in the form of a document like a board meeting. So the board meeting will be actually between him and the company. There is a board meeting take place. There nobody is attending except him, but he will only write down what are the various decisions which are taken. That is the way the board meeting is conducted in case of the one director is there.
Okay,
If more than one director is there, yes, obviously meeting will be there.
Okay.
That is the question here. The second question is, you can have more than one director to a maximum limit of 15 directors. That is absolutely correct. It is up to the sole proprietor, sole ownership. If he wants to have a more director in his board, he wants to bring the people, etc., he can appoint the director. There is no problem. Because OPC is nothing but it is as good as a private limited company only.
Exactly, sir. Yeah.
There is no difference between the OPC and private limited company, except there is a restriction of only one person who can have a control. That is the only difference here. Yeah.
Yes, sir.
Any other question, please? I don't see any other questions in the chat box. Nikhil, I think you have done an excellent analysis of all the provisions you have covered, including the various amendments.
Yes,
The
sir.
OPC form of the business, as I said in the beginning, it is a very, very new concept.
Yes, sir.
Enterprising entrepreneur, if he has got the capacity, if he can invest the initial amount of the money, the business is successful. He doesn't need to depend upon any other borrowing, any equity, etc., and all these things. He can definitely make use of this form because this is get limited liability, a brand name for his company, products, and he can get a facility from the banking. And
Yes, sir.
again, it is transparent, public domain information is available about the company. All these facilities, he actually gets it in case of the 1% company. As you rightly said, yes, it has got certain disadvantages. It cannot actually depend upon for raising fund. It cannot invite equity. It cannot collect for the deposits. All those things are all actually there if he wants to expand it.
Yes,
So
sir.
one has to take a balanced view. If he wants to be within his control, if he wants to grow the business in a way he wants, OPC is very much suitable. But starting with the OPC after expansion, if he wants to get it in a bigger form, yes, there are available opportunities in converting the firm to public, private, etc. He can grow also. So one has to take a balanced view and grow. I think this is the gist of the act. Thank you very much, Nikhil. You've done a
Welcome, sir. Thank you, sir.
job.
Thank you, Neetu ma'am.
Good done.
Yeah, thank you.
Can we proceed to the next session, Neetu?
Yes, sir. I guess Mrinal is ready. So I guess she'll be
Okay.
sharing the screen right now.
Okay. Next session,
Neetu
what
ma'am,
we are going
what
to
should I
have
do,
is
ma'am?
the risk management. As you are all aware, risk is there in everywhere. Where is no risk? Every day in day to day, our life also we face the risk. When you get up, you walk into the road, there is a risk of accident. If you travel in any vehicle, there is a risk of accident. If you walk in the night, if the suddenly lights are not there or powerful lights are coming, etc., especially the people, suddenly they get blind, there is a risk. Everywhere there is a risk. When you come to the business organizations are working what is going to be the future, what they are expected to. They are working with the target, they are working with the schedule, they are working with what is going to be achieved. They work the rolling plan of 5 years, they work for the current plan of 1 year. So there are many, many factors. What is holding today, what is estimated is not holding good tomorrow. Inflation is rising, prices are rising. There could be a shortage of raw material. Then things changes, fashion changes, styles changes. Product, what is actually good today, tomorrow it becomes outdated. Technology changes. So many things are there in case of the business. So naturally, there is a risk is there categorically. The business has to be managed with a reference to the risk. Because risk is definitely going to be there. How do we manage the risk? That is the gist of it. Suppose we face a risk, how do we actually overcome? Suppose we say there is some fire, flood, accident, etc. Yes, as you are all aware, that is why the insurance people are there. You make a small premium year after year, and suddenly something happens, they compensate to you to the extent what you are actually insured and safeguard. That is the way you transfer your risk actually. Some places you don't want to take a risk, you avoid the risk. In some places you want to reduce the risk. So there is always a possibility of managing the risk. So in the business, the identification of the risk, where the risk exists, how you are going to manage the risk, that is very, very important. And not only that, all the companies which are actually registered under the Act of Companies Act, either the 1956 Act, even earlier 1913 Act or 2013 Act. And again, the limited companies, they are actually governed under the SEBI LODR Regulation 2015. So both these regulators are also very much concerned, because the regulators are concerned to safeguarding the interest of the investors. The people who have put their hard-earned money in the form of the equity capital with these companies, they are concerned about safeguarding their interest. So naturally, the regulator has actually brought in a policy on the risk management framework. What is required to be done, what are the companies are expected to do. Companies should have the risk framework in the place. They should disclose what are the risks they are facing. They have to actually disclose what are the threats they are facing. All the things are actually in place. So naturally, risk management, A, business has to be managed with the risk. B, it has to be also shown to the shareholders, yes, we are managing risk, these are the risks. The disclosure is required to be made when they are publishing the annual, what you call the progress report, which is coming in the form of the board report to the shareholders of the company. And in case of the listed companies, they are required to publish corporate governance report and management discussion analysis report. This is required to be displayed. Of course, there is a website of the company on which also they have to actually put what is the risk management policy is actually formulated by the company. It should spell out how they identify the risk, how they manage the risk, how frequently they review the risk, how they are monitoring, how they are implementing. All these things are all actually required. So Mrinal will be actually taking us through the risk management. She will actually get us what is the risk, what is the management, how to manage the risk, what are the various risks. Again, followed by the regulatory compliances framework which are required, and more so, very much concerned to us as a professional, as a company secretaries, what is our role in contributing towards the risk management? Because one thing is very, very important. Because we being a professional, we are actually given in the latest 2013 Companies Act, we will to help the management in complying with all the applicable laws of the company. So if we don't comply, we run a risk. So that is where we are actually coming to the picture. So naturally, the role of the professional like company secretaries actually will come into the place. And plus, of course, the people who are actually doing the auditing or conducting the secretarial audit, they also have the responsibility to see that all the regulatory requirements are actually complied with while issuing their secretarial audit report or statutory auditor's report, etc. I think Mrinal will take us through this. So over to Mrinal. You can start your presentation, Mrinal.
Yes, sir. Good morning, everyone. My name is Mrinal Zhodge, and I'm currently working under Ashwini ma'am's team under the supervision of Ms. Poonam Pokia. So my today's topic is about risk management. Sir, am I audible?
Yeah, very much.
Yeah. Okay. So the word risk is obviously inherent in nature. Whenever, as sir said in the starting of the presentation, that whenever the moment we wake up, we are just bounded by risk. Like even if you wake up, you're crossing a road, you can just bump into a bike or a four vehicle. So risk is everywhere. You can't avoid risk totally, but yeah, you can mitigate or you can reduce the magnitude of threat it can cause to you. The word risk is usually, it can be explained in many ways depending upon the field and context. So risk usually means an uncertainty which can arise in near future, which you are literally unaware about. You can also say that risk is a type of an impediment to the achievement of an organization's objectives. So when you see a company growing too fast, you always see the tip of the iceberg, but you don't know what is there, what the company has been through, how the company has faced the risk and mitigated all the challenges which actually arise for achieving such a great progress. So So risk is, as you know, that managing risk is really difficult, even if it's in a company on day-to-day life. As per the Oxford Dictionary, it is an exposure to the possible loss, injury, and unwelcome circumstances. Like stress, we have to live with risk. It cannot be fully avoided, but yes, it can be managed and mitigated. So we can say that risk management, if you actually know how to manage risk, you'll know how to, you'll understand the possibilities which are there, which a company can actually face, and the way the company can strive and grow and progress. Yeah. So now we'll come to the classification of risk. Risk is usually of two types. One is the systematic risk and another is the unsystematic risk. Systematic risk can also be known as a normal risk. It cannot be fully controllable. It is macro in nature and it is usually unpredictable. So you are not much aware whether the risk will arise or no. It cannot be fully accessed or anticipated. So whenever it comes, you have to be ready with it. At least not fully ready, but at least you should know that there can be some type of a risk which can be arised. Coming to the next unsystematic risk, it is usually controllable in nature. It is micro in nature. If it is not well managed, it can cause a problem. It usually affects the individual organization, not a sector as such. Example of such risk can be compliance risk, credit risk, or operational risk. In the same way, example of systematic risk can be purchasing power risk, market risk, or interest rate risk. Types of risk. Risk can be classified into two types. One is the financial risk and another is the non-financial risk. Financial risk is something which has a direct financial impact on the entity. Example can be market risk, credit risk, liquidity risk, operational risk, country risk, etc. On the other hand, non-financial risk is something which does not have a direct financial impact on the business, but the consequences can be very serious. And later, it can actually cause a significant financial impact if it is not controlled at the initial or the nascent stages of the business. Type of risk which this category includes is the reputation risk, the transaction risk, disaster risk, business risk, strategic risk.
1 minute. When you talk about the credit risk here, I wanted to actually add here, company may be doing excellent business. They might be selling their products. and invoices are raised. People are all supposed to make the payment. When you drop the balance sheet, it will actually show receivables. So much is actually receivables. So we actually calculate about how much we have sold, how much we have billed. So we take the thing, we say company has made a good profit. Making a good profit is actually good. But unless the receivables, which is actually sitting in the current assets, if the money is not paid, which means the receivables are not converted into your bank balances, money doesn't come to the company's hand. That means you are doing an excellent business, but you don't have the cash at all because nobody has paid you. So with the result, what happened at the end of the year, if you have not received the money, although you have made a wonderful business, you will not be having a money to distribute your dividend to the shareholders of the company. You will not be able to have the money to make payment to your raw material suppliers. You will not have the money to pay to your even employees if the people do not pay you in time. Over a period of time, the money is not paid, it is likely to become initially a doubtful debt. Later on, it has to be written off. That is the greater risk which you are talking about, the credit risk. When you are talking about, that is the impact. What she is talking about, the credit risk. Correct, Birnal?
Yes, sir.
Yeah. Go
So
ahead.
I continue.
Yeah.
Yeah. So
Proceed.
coming to risk management. So as we all know, an organization is subject to a variety of internal and external risks. Risk management is applicable to all organization, whether it is a small entity, it is a large entity. It helps the organization to understand and to take actions on their risks. Effective risk management gives a comfort to the employees, to the customers, to the stakeholders. We can say that better risk management techniques usually provide a early warning signal, and which helps us to address the same on time. Risk management is, we can say that it is usually a commitment from the top management. So you cannot say that the risk management has to be managed only by the lower authorities. It has to start from the top level, because the top level management is much well versed and is much familiar with tackling the risk. Also, it is like a tool which is necessary for creating opportunities for the business, and so that they can develop proper risk management strategies. Risk management provides a framework to ensure that all the possible risks involved are understood and accepted, and important decisions are taken. It also helps to monitor the new projects and ongoing operations to ensure that they continue to develop satisfactorily and no extra problems are emerged. So we can say that we can conclude in such a way that it is desirable to have a holistic approach to the risk management that avoids compartmentalization of risks. So now we come to the risk management process. So risk management process consists of the following logical and sequential steps. First step is risk identification, which is followed by risk analysis, then the risk assessment, and finally the handling of the risk. So yeah, risk identification, as you know, if you want to find out any problem or any drawback or anything, the first thing is you have to identify the fields in which the risk can arise. So the first thing is the risk identification is the first stage of risk management strategy. It has to be clearly identified. The origin and source has to be identified actually. Correct risk identification ensures effective risk management. So the main objective of risk identification is to ensure that all the project risks are identified, and the ultimate purpose of risk identification is to minimize or to reduce the negative impact or the magnitude the threat of the risk can have on us, and to maximize the positive impact of the project opportunities. The output of the risk identification are used as an input for risk analysis, and it is an iterative process, and it has to be kept on going. So it is like you have to keep on identifying risk which will arise. So you cannot just stop when you come across one risk. It can also happen that in case if you come across a small risk, which is actually if ignored can actually cause a big threat to the company if ignored. Steps for risk identification. So we have here 6 steps. So the way you can identify a risk. So first comes creating a systematic approach. First thing, you have to be properly well versed and you have to have a proper decision making strategy as to how you identify the risk. Second is the gathering of information from various sources. Third is applying risk identification tools and techniques. So you have to be proper and correct in the choice of techniques you will take, you will adopt, because that usually depends how you will tackle the risk. Next is the documenting the risk. So you can document the risk by maintaining a register, and also you can note down the causes and consequences of the same. Next is documenting the risk identification process. It is to improve the and ease the risk identification process for future projects. Last comes the assessing the process of effectiveness. To improve it for future use, the effectiveness of the chosen process should be critically assessed after the project is completed. So once you identify the risk, you know how to solve the problem, or you know how to mitigate the same. It should be critically assessed in the sense you should actually have a proper look whether everything has been done properly. Sometimes you can just feel that the risk has been mitigated, but then there are some parts which are actually untouched. So maybe that can cause a problem in the near future. Now, third comes the risk analysis. So risk analysis helps us, it is the second stage. It usually helps us to analyze the risk and helps us to identify and manage the potential problems. Risk analysis should be objective and should be industry specific. To carry out the risk analysis, first you need to identify the threats and the likelihood of the threats. So first, sometimes there can be a risk can be too small and sometimes the risk can be too big. So you should know how much time you will dedicate to the particular risk so that you can avoid the consequences. So in case if a risk is not that much, it can be avoided, you can do that. But on the other hand, the bigger risk, it requires much discussion. It requires much more risk capacity, like risk mitigation strategies. You can just discuss it with the directors, with the board of directors, with the senior managers, so that it will help the organization to effectively control the risk and not cause a serious impact which it would have caused.
What she is talking about is there can be a fraud, there can be a theft. Theft actually concerned with a single person, which you can deal it very easily. Fraud can be done by the combination of the people. It will be difficult. And similarly, there can be a professional negligence when people are all carrying out the job, or even including our company secretaries, where we are also governed by the professional regulations, which are under the Companies Secretaries Act. And then there could be also due to the IT failure, because nowadays everything is on the online. We are actually hearing there are a lot of online frauds which are actually taken place. People lose money. In fact, people just get, whether you have been vaccinated or not, press 1, press 2. The moment you press 1, your all information or access, etc. and other things and all like that. So this is again, IT. Because nowadays we are more on the IT. One has to be very, very careful. Of course, the debtor default I talked about in the beginning. Then second thing is what we are talking about, unforeseen thing which can happen, which is not in our hand, like fire, earthquake, or tsunami. These sort of things which are actually there, this is not in our control. And suddenly something, the increase in the price, inflation, cost, etc. and all those things, which depends upon what is actually happening in the economy. And of course, resources, then again depending upon, because today's technology is outdated tomorrow. We do not know what is that, we should be ready. Then again, we are talking about the intellectual properties. Intellectual properties, it can be misused, it can be copied, it can be done, because we can run, because long time back we heard we are actually popularly using Colgate toothpaste, Colgate. Somebody has actually brought this similar to this, Colgate, Colgate. People go and ask for the Colgate toothpaste, he give you Colgate, which is not a Colgate. So this is also possible. So all this sort of the risk identification, as she puts it very correctly, it is due to what? That is very, very important. Then only you can actually tackle like that. If it is theft and a fraud, yes, that can be tackled easily, but the fraud, it requires much concentration and depending upon the things and investigation, etc. That is the way it has to go. Yeah, go on.
So now we'll come to the process of risk analysis. There are two processes for analyzing a particular risk arising in the company. One is to identify the risk and second is to estimate the risk. The first step in risk analysis is identifying the existing and possible threats that one might face. So they can be human, operational, reputational, procedural, natural, and political. So human threats can be illness, death, injury, or loss of any individual. Operational can be disruption in some operations or supplies, loss of essential assets, or failures in distribution. Reputational, as the word says, it can be due to loss of a goodwill. If a company deals into some if the company deals into some fraudulent practices and all, and then the company is bound to lose its brand image, which will ultimately reduce the sales and profitability, and the name of such company will obviously get tampered through brand image. Like the customers will stop buying such stuff. In fact, if a company is listed, you will just see a sharp downward trend in the share price. So that's how it can affect the company's reputation. Procedural means failure in the accountability, internal controls, etc. Natural threats, we can say, can be natural disasters, or you can say force majeure, like act of God, something of that sort. Political can be changes in the taxation policies or any regulatory policies, something like that, or some changes in law or regulations from time to time. Estimation of risk. Once the risk is identified, we need to calculate the likelihood and the threats that will be and the possible impact of the particular threat. So we can do that by multiplying the amount of the risk and then seeing the likelihood of it being repetitive in nature. So obviously it helps. This estimating a risk helps us to identify between the risk which will give you which can cause a severe damage, and a risk which can be just mitigated and does not require much attention. Risk assessment. So a risk assessment means a way how you can properly handle a risk. It must be correctly sized to the enterprise's size, complexity, and geographical reach. While assessing a particular risk, it is important how you determine the risk, whether it is inherent risk, residual, or it is both. The first activity in the risk assessment process is to develop a set of assessment criteria which can be used across the business units. To be effective and sustainable, the risk assessment process needs to be simple, practical, and easy to understand. It need not to be too complicated. It's not rocket science that you have to sit for hours together and do it. It is just a simple strategy where you can just hold a meeting, take everyone's ideas, and then you can come to a particular conclusion. It should be in such a way that even the employees are able to understand the strategy. So even if they face some or the other risk, they would not panic. They would use their intelligence and their knowledge to identify the risk and to mitigate the same. Handling of the risk. So as the word says, you need to properly handle the risk. So the ownership of risk has to be allocated. You cannot say that only the employees will be the ones who will be handling the risk, or only the top management will be the ones. You can have risk policies, which usually is drafted by many listed companies. Listed companies usually have a risk management policy drafted by a company secretary or a director. This has to be circulated to the all senior personnel as well as the subordinates, which will help to reduce the risk. And as we say, a teamwork will always help rather than a person singly working on a particular project. So in the same way, if a company faces any sort of a risk, it is the duty of the organization to work in teamwork and see to it that the consequences are considerably reduced. So risk can be handled in many ways. That one can be risk avoidance, the other is risk reduction and risk transfer. So risk avoidance, as the word says, we can avoid the risk by choosing something which can cause less risk to us. Like if you opt for a stock market share, it is upon you which company you would like to invest in. So sometimes people don't much invest in companies having high risk because they are much tensed. That is the human psychology, because we don't tend to invest in stocks which are risky, because you know that in near future, what if the company goes into liquidation and your money is all gone? So usually we invest in companies which have a high reputation, or which have a good corporate image and all of that. Next is
Good corporate is okay, but what happened with the Satyam computer? Everybody invested, suddenly Satyam's computer collapsed.
pardon, sir.
Satyam computer.
Sir, you're
Satyam
not audible. Hello. Hello.
Satyam computer.
Yes, sir.
What happened, Satyam computer? Everybody started investing. They were having a good amount of the money. They got a good track record, reputation. Many awards they have won. One fine day they collapsed because of the scam. So we can't say anything. But only thing is, you have to take a calculation. You have to find out. You have to keep your eyes and ears open. What is happening?
Yes, sir.
Yeah.
So shall I start?
Yeah.
Yeah. So the next part of handling a risk is risk retention or absorption. So handling risk, it is handling the unavoidable risk internally, and the firm bears or absorbs the risk. It is due to the fact that maybe a particular risk, when you face a risk, maybe there is no insurance as such, or maybe it is too expensive to cover that risk. So usually organizations, you think of absorbing or retaining the risk. There are two types of risk retention methods, such as active risk retention and passive risk retention. So in active risk retention, it is a situation where the risk is retained as a part of a management strategy after evaluation of possible causes and losses. So not necessarily every risk a company faces, the company will retain it. It has to see the amount of destruction and threat it can cause to the company. Next one is the passive risk retention. It is a situation where the risk retention, it can be occurred due to negligence. Such type of a risk is unknown, and because of risk taker is either does not know how the risk can be considered or what the risk is. So this can, you are like, this type of risk is unpredictable. It can cause due to negligence, or maybe the person is not well aware about how forms the risk can come into a company. Next is risk reduction. So in many ways, physical risk reduction or can be possible. The ideal time to think of risk reduction measures is the planning stage of any new project. The cautionary note regarding risk reduction is that as far as possible, the expenditure should be related to the potential future savings in losses and other risk costs. We can also say that risk prevention generally is evaluated in the same way as other investment projects. The last part is risk transfer. So I can say that this refers to a legal assignment of cost of certain potential losses to another. There are three means of loss transfer, which can be in the form of tort, by contract other than insurance, and by contract of insurance. So the main method of risk transfer is insurance. So in case if you face a risk, some companies usually ensure the risk because it can be later compensated by the companies, and it can actually help the company in the near future. Risk mitigation. So risk mitigation, as the word says, mitigation means to reduce the consequences, the the negative consequences of any element. Risk mitigation is defined as taking steps to reduce the adverse effect. You can say that it helps to reduce the severity of a particular type of risk or the consequences which can arise. Types of risk mitigation can be transferring of the risk, or you can just tolerate the risk, as I said in the previous slide. You can reduce the risk, you can avoid the risk, you can combine, you can share the risk, or you can hedge the risk. So risk mitigation, it involves a development of risk mitigation plans, strategies to reduce or eliminate the amount of risk at an acceptable level. So now we'll come to the role of a company secretary in risk management. As we know that the company secretaries, which are also known as the compliance officers of the company, as per SEBI, they are the governance professionals and whose role is to enforce a compliance framework to safeguard the integrity of the organization and to promote high standards of ethical behavior. He plays an important role in the board organization and achieving its strategy and vision. He acts as an advisor to the board in ensuring good corporate governance and also helps the company in the integrated framework on which the internal control is built. Listing agreement, there is also a listing agreement which provides for establishment of risk management committee as per the regulations. Since as a part of corporate governance norms and non-compliance of the same is to be reported by the company secretary. A company secretary also can, we can say that a company secretary can ensure that the risk factor can come into consideration at every stage of formulation of a strategy. So when a company secretary is forming a opinion about something, or if a company secretary wants to formulate any strategy, he or she has to see about the risk factors also. You cannot only think about the future in the way that a company will get profits, and you cannot only think about the profits and the dividends which you'll pay to the shareholders. You also have to see the other consequences, like the ancillary part of it also. Functions of a governance professional. In this, we can say that function of the governance professional is to advise on the best practices in governance, the risk management and compliance. You can balance the interest of the board and governing body, management and other stakeholders. You can promote and act as a sounding board on the standards of high ethical and corporate behavior. Yeah, so now we come across the model risk management policy. So a risk management policy is it usually have to be drafted by companies, listed companies specifically. It is a voluntary action. If a private company wants to do it, it can do it for good corporate governance also. So a risk management policy usually serves two main purposes. One is to identify, reduce and prevent the undesirable incidents and outcomes. And it should also help to implement the changes to prevent and reduce the future incidents. A risk management policy can include the following sections. One is the governance, that is risk management and internal control objectives. Second can be a statement of attitude of the organization to the risk, that there is strategies, you can say how there is various risk strategies can be adopted and how you can effectively mitigate the same. Description of the risk aware culture and control environment. Nature, level and nature of risk that is acceptable, that is the risk appetite. So if you want to face any risk, you should see the appetite, you will see the capacity the organization can actually take the risk. It doesn't mean that it's usually said that you can actually take that much risk which you can face. In case if you go for a bigger risk and your company is not ready for such type of risk, it can cause a huge loss, it can cause a huge problem for your company and the shareholders. Next is the risk management organization and arrangements, that is the risk architecture. Next one is risk mitigation requirements and control mechanisms and how you respond to the risk. Allocation of risk management roles and responsibilities, risk management training and topics, criteria for monitoring and benchmarking of risk. So there has to be a particular way in identifying the risk. You cannot just take every risk which comes to your way and keep on drafting policies for reducing the risk. Sometimes the risk can be easily mitigated. Sometimes it requires a high amount of decision level thinking to reduce the same. And also allocation of appropriate resources to risk management, risk activities and risk priorities for the coming year. So now we'll come to the regulatory framework of risk management. So under risk management, we can say that it is covered in the Companies Act 2013 and SEBI LODR Regulations 2015. Under the Companies Act 2013, the framework comes under the responsibility of Board of Directors and the responsibility of the Audit Committee. While under the SEBI LODR, it comes under the responsibility of Board of Directors and constitution of a Risk Management Committee. So as per the Companies Act 2013, when it comes to the responsibility of Board of Directors, Section 134 of the Act says that a statement indicating the development of a risk management policy for the company can include various elements such as identification of the risk, or in the opinion of the board, which may some risks or elements of risk which can threaten the existence of the company. Coming down to the responsibility of the Audit Committee, every audit committee or a company which is required to form an audit committee shall act in accordance with the terms and reference, and shall also include evaluation of the internal financial controls and risk management in line. So from this we can conclude that in lines with the above requirements, it is therefore required for a company to frame and adopt a risk management policy for the company. As per the SEBI LODR Regulations 2015, the responsibility of the Board of Directors, Regulation 17 of the SEBI LODR states that the Board of Directors shall be responsible for framing, implementing and monitoring the management plan for the listed entity. Constitution of the Risk Management Committee. As per Regulation 21, the Board of Directors are required to constitute a risk management committee and also to define the roles and responsibilities of the committee. They also have to monitor and review the risk management plan to the committee and the functions as may deem fit. The company is therefore required to formulate a risk strategy, strategic risk management policy pursuant to the Companies Act, applicable to all the companies, and SEBI LODR, which is applicable to the listed companies, in addition to the Company Act provisions. So here we can conclude that every company, especially being a listed company, has to formulate a strategic risk management policy, which is very important as per the regulations. And in case if a company is not listed on the stock exchange, being a private company, it can also form a risk management policy which can actually help the organization to, it will reduce the burden, I can say, in the near future in case a company faces a risk. So you don't have to wait for the last moment to actually plan a risk management policy. When it is already drafted, you can come across the, you can just go on the, you can just read the policy, you can take the required actions as such. So this will actually help to mitigate the risk faster. If you have everything in place and everything is well much properly done. Disclosures. So disclosures have to be usually done in the board report also. So in the board report, as we know, the directors have to disclose the management framework, saying that the board has properly monitored and reviewed the management strategies, and it has it ensures that the effectiveness and implementation is proper. The directors can also state that they have taken necessary steps in reducing the risk which has come during the life of the company, and which has actually helped the company to reach to achieve its goals in the report on corporate governance, which forms a part of the annual report, and as per SEBI LODR, it can read with the Schedule 7 together with a certificate from a practicing company secretary. It can disclose the compliance and requirements of the corporate governance and how the company has complied with various laws and disclosures from time to time as per SEBI LODR and other laws. Management discussion analysis report, which is a part of the board report, especially for the listed companies. In the MDAR report, which is included as a part of the annual report, the board of directors are required to state the internal control systems and the adequacy. That is, you have to, the board of directors, the responsibility of the directors to tell the shareholders about the adequacy and the efficacy of the internal controls which a company has or the company has adopted, and risk management to ensure that the assets are properly protected from any unauthorized use or disposition. Then comes the secretarial audit report. Usually we know that secretarial audit is a process to check the compliance with all the relevant laws and provisions and adherence to the good corporate governance with regards to the systems and processes for seeking and obtaining of the board and shareholders that may be necessary to carry out a legitimate functioning of the company. So a secretarial audit report is usually issued by a practicing company secretary, and which should state that a company secretary has examined in compliance to all the relevant standards and all the relevant rules and regulations, that the company has complied with all the required compliances, and certify and review that everything is in proper and within the guidelines of the guidelines issued by the respective regulators. Business responsibility report. Now, usually the listed companies are required to make a disclosure in the business responsibility report, saying that all the policies have been approved by the directors and the same has to be posted on the website of the company with the details under the heading of investor information and under the section of policies and disclosure section. Further, the companies are also required to make a declaration saying that the company has adopted the best practices as per the regulatory requirements, and the policies have been properly drafted and been reviewed by the board from time to time, and necessary changes or amendments or alterations we can say has been made in the policies as required by law from time to time. So we cannot say that if you make a particular policy, the policy will be kept or it will be hosted on the website for many years. You have to keep on changing the terms you can say, or you have to keep on altering the clauses which can actually help the company to face the risk effectively. Independent auditors report. So we can say that the auditor has also in his report has to form an opinion about the adequacy of the internal financial controls with respect to the financial statements and the financial controls with reference to the financial statements that have been that has been effectively done by the company.
Can you just go back one slide before?
Pardon, sir?
One slide before?
Yeah, just a second.
Yeah. Previous one?
Yeah.
Previous one, previous to this.
So this one?
Yeah.
Okay.
So here, you all people will be knowing it. Earlier, it was actually a business responsibility report. Now the SEBI has actually come out and they have actually brought a modification to the business responsibility report. Now they have introduced what is called business responsibility and sustainability report. So that has been added because the sustainability word has been now added, because that occurs very much important, because one has to analyze the risk and you have to see how you are going to achieve the sustainability in the business. So to that extent, the SEBI LODR regulations are going to change. Earlier, it used to be a business responsibility report. Now it is actually a business responsibility and sustainability report. That is what I want to bring to the notice. Okay, go ahead.
So now conclusions. So I can just say that risk management by an enterprise has to be properly identified. There has to be a proper strategy to reduce the risk. Risk can be tolerated only till a particular level, as long as you know how you can face the risk. In case if you fail to identify some risk which is hidden or which cannot be identified in the first instance, it can does cause a problem. So risk is there. In case a company, I will not say that every company is well versed with all risk mitigation tools. There can be some differences and variances as per the policies also, and how a company tackles the thinking of the managerial personals, how they think, the thinking capacity. So it keeps on changing. So you cannot say that every company is going to effectively handle a risk. Risk comes to the company in some or the other way, and it can cause a problem, but it is upon the organization how well you can strategize everything, and you can face the risk and reduce the risk consequences. For this, the board has to regularly review the risk registers, and it has on the recommendations on the management committee. The risk is required to be monitored until it is fully mitigated or it is no longer a bigger or a significant risk. So you cannot say that if one part of the risk is mitigated, you cannot say that the other part will automatically be mitigated. You actually have to keep on going till the risk is actually the magnitude of threat which it can cause has considerably reduced. We can say that a well-defined framework of risk management, the management of the company needs to control the risk and mitigate them wholly till no risk occurs. So yeah, this is my presentation on risk management. And yes, I've taken some of the points from Bala sir, which he had sent me from the PDF, which has really helped me in understanding the concept of risk management, and hope to clear my exams with this knowledge of mine.
Excellent, Bernal. Very good presentation. You have made it actually.
Thank you, sir.
You brought out the things very nicely. All the aspects you are actually covered. There is one question is there in the chat box. BRSR is applicable to the financial year 22-23. Does it mean in the current year it is not? Current year, either you can give the business responsibility report, or voluntarily you can actually publish business responsibility sustainability report, which is not today, but in the next year onwards, it is mandatorily, it is required. That is the requirement.
Yes, sir.
Yeah. Any other questions on this risk management from participants? Let us come to the CS professional is concerned. As she rightly said it, how do you reduce the rate? How do you mitigate the risk? In the secretarial compliance, certain non-compliance happens. Take any example of non-compliance, non-filing of the form. Filing is required to be done within 30 days, it is not filed. The moment you actually detect, the moment you file in the next month, then you pay only 1 month additional fees. If you keep code for 6 months or 7 months and 8 months, your fees keep on increasing to such a period. That is how you actually end up in paying the more money there. Second thing, you are required to take certain action within a specified period. For example, a company secretary who is there in a company is actually resigned. His vacancy is to be filled up within 6 months. If you have not filled it within 6 months, you have taken 1 year, you have filled it up, all right. But the period of 1 year, the delay, you actually are liable for that because there is a non-compliance. The question is whether you want to actually go for the compounding on suo motu on your own and close the chapter, or you simply sit quiet, you will wait when the regulator comes, we will take action. What is the question will happen? When the regulator finds out and takes action, there will be a severe penalties will be levied on you. If you actually go voluntarily, if you say, sorry, there is a mistake has happened, generally I'm interested in mitigating mistake, I'm filing a compounding application, the nominal fees will be paid. So that is the way one has to actually look into. Because many organizations definitely actually do, they mitigate the risk by taking the voluntary action. That is what they do actually. So that is the way we'll have to actually check it up. We'll have to take the call on that. Yeah.
Yes, sir, we can end the session.
We can end the session. I think let us see the chat box.
Okay,
There is
sir.
any question is there? Anybody, any question is there in the chat box?
No, sir. I guess no. No, sir.
Okay. Then I think we can end the session with this. My appreciation to Mirnal and even Nikhil for the excellent preparation and done the good homework. We hope to see you in the future sessions whenever it is coming up. I think next week it is going to be a Ganpati Chaturthi, I believe. Am I correct?
Yes, sir. Yes, sir.
Yeah. So there won't be a session in the next week, I believe. Yeah. Yes, Neetu.
Okay. Okay. Thank you, everyone. We'll see you in the next session. Thank you so much.
Okay, good day. Thanks a lot to everyone. Enjoy your weekend.
Thank you.